not, that money is being given to you by biz trade. Now, when you trade on that money, you you can make profits, and you share profits with the company. Meaning you company is putting its own money on stake, and we teaching you how to trade as well. And when you're trading on that, now when you make 10%, we upgrade you, or you get a 5,000 euro account with no restriction to trade. That's why it's and you know what, we've got a living proof here. We got Mr. Happy from USA. He has done it, and without any previous experience. That's why if he can do it, anybody can do it. All you got to do is you need to be coachable. You need to follow instructions. Do not go into greed, because greed is the biggest enemy of trading. Use your stop losses, because people get cocky. People get too when they see good results. What they see is, you know what, let me gamble. Now, this is not gambling, guys. This is all calculative decisions. Okay, there's a difference between gambling and trading. Now, people who lose money in trading, they are not trading, they are gambling. Okay, that is the difference. So try to understand the difference between trading and gambling. Okay, I'm not saying gambling does not create success, but let me tell you, it creates more failure than success. Okay, so don't be a gambler, be a trader, and please follow the strategies, follow the teaching. People who lose money in trading, the reason is because they have not followed a system. People who are following the system, they are producing the results. And plus, we've got a world-class system. I can put my hand on heart. Let me tell you, there is no comparison of Bizzcareer. What we have created. I'm not saying it. People who have been shopping around, people have been spending 4-5 times of what they paid to us. They paid other companies and never got the results. I'm talking about the number 1, number 2, number 3 companies in this space, running from over 10-20 years. Our system, they're saying that our system is 10 times better. And what they say, proof is in the pudding, because all Bizzcareer members are satisfied and they're making money. That's why this is proof that the system works. That's why now what I want you to do, guys, to invite people to this call. Now, you don't have to force them. They need to come. They need to, with an open mind, they need to see this information and make decision. You don't have to make their decision. They have to make their decision. Only they can change their life. Just like you have changed your life through this amazing system, they can come into this system and they can change their life. All we got to do is we need to point them to the right direction. We need to show them the right path, and we can help so many families who are struggling in this difficult time. Now, I want to finish my talk by saying that there is hardly a difference between an intelligent and a stupid person, and the difference is there's no difference between hardly a difference between a stupid and intelligent person. And why I'm saying this is because both of these individuals are not ready to listen. That's why there are people who are saying, you know what, they know, you always find somebody who knows everything. Okay, I know this because they know, as I said, there's no difference between a stupid and an intelligent person, or too stupid or too intelligent. Because they both don't listen. They both don't listen. And we want likable, teachable, and people who really wants to change their life, and they are ready to listen. Because once you're ready to listen, you will see that system works. We have and I'm not just saying it. The results speak for itself. we've got so many success stories. That's why if we had one, if we have like 87% people failing, or 50% people failing, or 20% people failing, or 10% people failing, or 1% people failing, then we can say, you know what, there is a 99% chance. If I would say 90% chance. In here, we're getting 100% results. That's why there is no chance. Just people need to sit down and listen that this system works. It works because I'm not saying it. No, you don't need to believe me. You need to check the system. You need to speak to people who are part of this system, because it works for them. It will work for you. Thank you very much. I'll pass it back to the legendary Paul Chalmers to get people out of poverty. Okay, thank you very much.
Okay, since we've talked about people who have been successful, let's just unmute Happy. Happy, you've got 30 seconds to say something. I'm just unmuting you. No, not yet. Let's try again.
Hello, everybody. My name is Happy, and I'm happy because I took my brain when I was a year old. And I didn't care what people say. When I want to learn how to talk, how to walk, I had a commitment. I was saying ta, 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 but I was not willing to quit. And then one day I said, Mama. And the same way, when I took the first step in Bizzcareer, I start doing D, and now I can say dollar. Very simple. Be coachable, be teachable, and be workable and duplicatable. Listen, Paul Chalmers. I'm honored, blessed, fortunate, lucky, and of course, I'm happy at the end that I listen him.
Thank you, Happy.
You're welcome, brother.
Everyone. Well, what we're going to do now is make a start on module 2. Now, what I'm going to do, let me just set everything up very quickly and share screen. And then maybe let's just go back to Haida for a second. Just tell me when you can see the screen, Haida, and you can tell me when the Bizzcareer page comes up.
The screen.
Thank you very much. And then we'll make a start. Okay, so welcome everybody to module 2. We started module 1 yesterday. We've got 4 modules to teach you a little bit about Forex and how you can make money from Forex. And what we did yesterday is we went through a number of areas and started to understand what Forex market was all about. Today, we're going to have a quick review of module 1. Then we're going to have a look at different types of Forex trading. We're going to look at how you actually make money in the markets. What's the actual way of doing it in simplified terms, when to buy and sell, and also what is a pip. So we're going to start to introduce you the nomenclature of Forex trading. Yeah, the buzzwords and what they actually mean. Now, if we look at yesterday, we did a couple of things. The first thing that you learned was what the Forex market is. It's actually a global market. And what you do within Forex trading is simply you trading a currency against another. That's the simplistic way of explaining it. Now, it is the largest market in the world. It's the largest liquid market in the world, in fact, and it's the biggest industry in the world. We have over $5 trillion traded per day. Anything between 5 and 6. Nothing comes in comparison with that. And you saw that when you look at all the big exchanges in the world, then they are nothing compared to the Forex industry. You also learned that there's basically 3 different sessions that you have in 24 hours. The markets open on a Sunday night at 10 p.m. UK time, and they close at 10 p.m. on a Friday night. So you can trade them 24 hours a day. We have the Asia market. They're the first market to open. And then you get the UK market and the USA market. You now know that the UK market has the most amount of volume going through it. The most amount of trades in volume are traded in the UK market. Then comes the USA and the very quiet Asian session. Also, we have a number of major currencies. the euro, the Japanese yen, GBP, USD, and the Swiss franc. To place a trade, what you're actually doing is you're not buying and selling a certain currency against another one. When you trade something, as I said, called a derivative. In other words, you've derived something to be able to trade the markets from instead of just buying pounds against US dollars, because that's very expensive. You need an awful lot of money in your account to actually buy and sell the physical fiat currency. So what we're doing when you are trading is you are trading on the direction of the market, which way the market's going to go. And what we're going to do today is start looking at the bits and pieces of how you win and also how you lose money in Forex. So we're going to start looking at the different types of items where how do you measure how far you've gone? What does that mean? And then you obviously multiply it by the amount of money you've put in. So that's what we're going to start looking at today. You also know there's major markets, normally with the USD in it. For example, Euro USD, USD Japanese yen. They are the major markets and they have the greatest amount of liquidity. Okay, the best markets to trade. They're not so jumpy. You also have the minor markets, which is a combination of anything which isn't the US dollar, for instance, GBP against Japanese yen. And then you have the exotics. Now, most of the trades that are done in the world are done on the major currency pairs. And if you look at currencies themselves, the US dollar is about 85% of all transactions that are done in Forex trading. So that's what you learned yesterday. You learned a bit about the Forex market. What we're going to do now is today go into a little bit more depth about how you measure the Forex market, how it moves, how much it moves by, and how do you work it out. If we now look at how you make money, the object of Forex trading is to exchange one currency against another. That's the main object. You expect, the expectation obviously is that you're going to make money because you've chosen the correct direction. But you can make incredible profits from the Forex market. There's a lot of money swirling around the Forex market. So if, for instance, you bought a market and the market went up, you would then have a profit. And to realize that profit, you'd then sell what you've already bought. So in other words, you close the trade. Now, the exchange rate, as you know from yesterday, is simply the ratio of one currency valued against another. Now, that means you have two different currencies within a currency pair. For example, let's take US dollar, Swiss franc. Now, that indicates how many US dollars you can purchase for 1 Swiss franc. Or in other words, how many Swiss francs you need to buy for 1 US dollar. Now, if we look at how to read a quote of Forex, so a Forex quote, what does this mean? Well, currencies, as you learned yesterday, are always quoted in pairs. For instance, GBP against USD. Now, the reason that they are quoted in pairs is that in every foreign exchange transaction, you are simultaneously buying one currency and selling the other. So if you put a buy on GBP USD, what you're actually doing is saying, I'm buying GBP and I'm selling US dollar. Now, then how do you know which currency you were buying and which one you were selling? That's where something called base and quote currencies come in. Now, currencies are quoted in relation to other currencies. So let's have a little look. Let's have an example. For instance, here we go. Now, you have here the GBP, which is the base currency, and you have the US dollar, which is the quote currency. Now, you always have a quote currency and a base currency in every single currency pair. So for example, if the GBP, you've got GBP against US dollar is 1.21228, you often see these rates when they say, oh, the pound has dropped against the US dollar by this amount. This is what they're actually saying, because this is the number of dollars you get for a pound. So you get $1.21 for every pound. Now, when you buy the exchange rate tells you how much you have to pay in units of the quote currency to buy 1 unit of the base currency. So therefore, in this one, when you go to an exchange and you put £1 in, you're going to get $1.21 back. Now, when selling, the exchange rate tells you how many units of the quote currency you get for selling 1 unit of the base currency. If we take, for instance, an example like the euro US dollar, okay, again, that means that when you put in €1, you will get a certain amount of US dollar back for that. So you're buying the euro and you're selling the US dollar. Now you would buy a pair. This is when we start to go into trading. You would buy a pair if you believe that the base currency will increase. Yeah, so in other words, the pound is going to go up. That's when you buy. Now you would sell the pair if you thought that the pound was going to drop. With Forex, it's not like stocks and shares. You can win if you get the direction correct, whether the market goes up or the market goes down. Now let's look at currency pairs. So you've got lots of currency pairs. There's so many currency pairs to trade. How do Forex brokers know which currency to list as the base and the quote currency? Well, thankfully, we have a standard within the Forex markets. You will have seen previously a slash, GBP / US dollar. Now, what that means is that they are taking one currency against another. So when you have a load of currency pairs, the slash distinguishes between the first and the second currency. As an example here, yeah, we've said the base currency. If this is the market and you're about to trade, okay, the base currency may say it's at 1.105 and the quote currency is 1.1053. So this is your bid and ask prices. This is the difference that you get in the market. It's just the broker takes a little bit of spread. So when you go into a buy, just imagine a 100-meter race. When you go into a buy, they take you back a little bit from where the market is. So you've got to make that up. It's like telling Usain Bolt, right, you've got to step 1 pace back behind everybody else to start in the market, in the race. So what you're doing is you're buying and selling one of the currencies against another. So long and short. Now, first thing you want to do is determine whether you want to buy a market or sell a market. If you want to buy, and you now know that that means buying the base currency and selling the quote, you want that currency to rise in value. You want the market to go up. And then when it's gone up at the higher price, you close it. Now, to close a buy, you actually place a sell. You actually say close, but it actually places a sell to close it. Now, in trader talk, this is called going long. You're taking a long position. So long actually means buy. If you want to sell, then you want the currency, the base currency, the first currency to fall in value. And then you would buy it back when it's gone down. Now, this is called going short. If you're short in the market, you might have heard the term, oh, they've shorted the market. That means you sold, because short equals sell. Now then, spread. This is what I was telling you about starting a 100-meter race. The broker has to make money. Okay, so you have something called the bid and ask price. The bid is the price at which the broker is willing to buy the base currency in exchange for the quote. And also, that means that if you want to sell something, they'll have an ask currency. So basically, in simple terms, what it means is when you place a trade, they put you a little bit behind where the market is. If you're in a buy, you'll go a certain amount below the market. If you're in a sell, they will put you in a little bit above the market. So you have to make up that little bit before you really start the race. But the spread is how the broker makes their money. Okay, now then, you can see it on here. Let's bring this one up again. Now, if you've got a bid and ask price, these are the two different values. Yeah, 1.1051 is an example, the Euro USD exchange rate is, and 1053 if you want to sell. Therefore, the spread is the difference between the two. And 1.1053 minus 1.1051 is actually 2 pips, because this last digit is actually 1 pip. That would be 3 pips. 53 would be 53 pips. 1,053 pips. Okay, so the difference is 2 pips. And therefore you're going, and a pip is basically a point. In Forex, points make prizes. So if you make 2 points, however much money you put on a point, that's how much you win. So say you put, for instance, £1 a point on. The broker's going to take £2 off you for placing that trade. But every point that you then make afterwards, you make £2 for every point it goes in the right direction for you. So now you can see what all the various different items are. So you now know that you've got base and quote currencies. You can see the currency pairs. You now know what going short in the market is, going long. It's basically selling and buying. So you're going to be in the right direction to make a profit. Now then, let's take as an example, Euro, USD. Let's put a market on here, shall we? This squiggly line is basically the market going up and down. So what we're going to do is we see the market going up. So if we will put a buy on. We think the market is starting to go up. So let's put a buy on at this point in time. So in this example, the euro is the base. So the first one is euro is the base currency. USD is the quote currency. Now you believe that the US economy is going to weaken. Yeah, with everything that's going on and COVID's increasing, you think the US dollar is taking a battering at the moment. So the US dollar is going to weaken. Now, if the second currency weakens, it means that the euro is going to get stronger against it, so the market will go up. Now, if the market goes up and you're in a buy, you're going to make a profit by a certain number of something called pips. It's just if you're going on a journey, yeah. The measurement of distance is miles or kilometers. Well, in Forex, it's called pips or points. So it's going to move a certain amount and you're going to take a profit at some point in time. So that is how you execute and look at which way a market's going to go. You need certain indications to tell you whether to buy or sell. Now then, it's later on in the month and the US dollar has done very badly. The euro's gone way up against it, which means the dollar's weakened, and then it starts turning around because everything that goes up in Forex comes back down. So you say, I'm going to place a sell at this point in time. The market's coming down. It's looked like it's coming down strongly. I'm going to place a sell. So this means that you now expect the US dollar to strengthen, the euro to weaken. Market comes down and you make another profit. Let's have a look again at, say, US dollar, Japanese yen. Now, this time the US dollar is at the front. So this time the US dollar is the base currency. So if the US dollar strengthens, because it's the first currency this time, it means it expects the market to go up, and that's what happened here. So therefore, say if you expect the Japanese government is going to weaken the yen, yeah, countries weaken currencies because then their goods are cheaper and it helps them to export goods. Now, the US dollar, for example, at the moment is becoming very weak. It's because of what's happening over there. But from an export point of view, they're loving it because it's cheaper to buy US products. So these are all the sort of things that you learn in Bizzcareer to understand which way the market is probably going to go. And of course, it comes down the other way and you say at the same point in time, the market's coming down. The information that we've got tell us that we're going to sell. You place a sell and the market goes down and you make a profit. It's the same thing. So you look at which is the first currency and the second, and that tells you which direction you should trade in, either buy or sell. Let's just take one final example, just to put it into your mind again. GBP USD. You always look what the first currency is. If the GBP strengthens, it's going to go up because GBP is first, which means the US dollar is going to weaken. If you think the US dollar is going to strengthen because it's the second currency, then the market will go down. So we're at this point in time again. And hey presto, we have seen our indications telling us that the pound is going to rise because the dollar is weakening. And you place a buy and hey presto, it goes up. Same thing. At this point in time, the US dollar is strengthening. Or we could find that the pound is weakening. We're not getting a Brexit deal. The market flew down this morning because there was concerns about that. And then there was a little section this afternoon which said that it looks like an agreement could now be reached, and the market flew up. And in Bizzcareer members made an absolute load of money during that period of time. So, you know, a lot of things can change. So we're seeing the GBP this time. The Brexit is going badly. Pound is dropping. You place a sell. So as you can see, what I want to show you here is the markets move up and down. And they move up and down because of something happening within the market, something happening in the economies. And you get to learn this and learn and understand what can potentially happen, the probability of the market moving in a certain direction. Now, we have the index, of course, so we know exactly what's happening. Now we're going to go on to this thing called a pip. What is a pip? So you're slowly but surely learning more now about the Forex trading. To make money from anything, two things need to happen. The first is the measure of movement. And secondly, what is the amount you put onto it? Just as an example, you're in a car and you're going a certain distance, yeah? You need to know how much your car uses per gallon per mile at a certain speed. And you also need to know how far you're going. You can work out then how much that journey is going to cost you. It's exactly the same in the Forex markets. So the first is the measure of movement. And then second is the amount you're going to put onto it. And we'll talk about that next tomorrow. If you multiply those two things together, you get a financial result. So first, what we're going to do is look at the measure of the Forex market, the movement of the Forex market, and then we can see how far the markets actually move. Now, you may have heard of the term pips or points or pipettes even. The pip is the unit of measure. You can measure the distance that the market has moved. Also, as an example on the euro US dollar, the fourth decimal place is actually 1 point. So if you say that the euro against the US dollar is 1.1041 at the moment, the last one is a pip. So if that moves to 4.2, it's moved by 1 pip. The pip normally is the fourth decimal place, always the fourth decimal place. We have a little variation on the Japanese yen, but they're only two currency pairs, two crosses. So I'm not going to confuse matters by that at the moment. We're going to look at the standard, which is 90% of all the markets that you would trade anyway. Now, we also have something called a pipette. A pipette is 1/10 of a pip, because most Forex brokers used to be 4 decimal place brokers. Now they've gone to 5 because they like to put a point something of a pip movement as well. And this is called a pipette. It's 1/10 of a pip. So if we look at this, you can see very clearly 1, 2, 3, 4, this is a pip. And the next value is a pipette. So if you see when the market is moving, now you can say, well, the market's moved 200 points. You know what that means. Okay, the final item. If you look at a Forex market, this is how it is chopped up, so to speak. You have 5 decimal places. You already know that this is a pipette. In other words, it's 1/10 of a pip. So if there's a 2 at the end, obviously it's 0.2 of a pip. The next one are units. So that would be 8 pips as an example, but this is the unit level. And these are the tens. So that's actually 30 pips. These are the hundreds. So this is 500 pips. These are the thousands, and these are the 10,000s. Now then, the Forex charts, the vehicle of trading. What actually is the vehicle of trading? Well, I'm going to show you. I'm going to bring up a Forex market, and we're going to take a little look around my Forex world. Okay, now this is the vehicle that we use to trade the markets. Okay, this is called MetaTrader 4. And what you have here is you have the movement of the market. If we look at the market today, then this is on an hourly chart. So every one of these bars is on the hour. As you see, there's the news that we were running into trouble with Brexit. There's the return, and market suddenly spiked up, and we took all of this. We were in this trade going up here. Let me just expand it a bit. There we go. We were in this trade coming up here. So what you've got is a bar, one individual bar. Now, if you look up above, you got H1, which means that in an hour, this is what the market did. So I'll expand it again and just show you as an example. So this bar starts here. You see a little wick down below and a little wick up above. What's happened here is the market's come and opened. It shot up because of the news and then returned and closed at this point. So this is the body of the bar. This is where the hour opened, and this is where the hour closed. And the wicks are the extremes of where the market actually went during that hour. Now, if we measure it, we have 5 decimal place brokers. So the number you're going to see is actually in tenths of a pip. Now, if I take this and we have a look here, you're going to be looking at the center line. If we take the bottom down here where it opened, and have a look how far it went. Now have a look at where that X is that I've got this crosshair here, and you'll see the center number is 585. In other words, that has gone up 58.5 pips. Now, if you had a pound a point on that and you opened it and closed it here, you'd make 58 pounds. Now our members actually made 70, I think it went up 70 pips, and we told them, if it comes back down to 50, take 50. So everybody today on this trade made 50 pips around here. Okay, so we made profit there. So this is what the market looks like. And you can go back, if you put it onto months, you can go back and look at months from time beginning actually. And you can see many, many things from that. You can see, for instance, when, I don't know if you all remember the crash of the markets in 2008. Remember, all countries went into recession. Look at that, woof, down there. Now this is the monthly chart. So if we take this, let's have a look what happened to the GBP. 6,474 pips it dropped. 6,474 pips between the 1st of July 2008 and the 1st of April 2009. Every country was in a recession. This tells you everything. You can even see, I would say, there it is. You can even see the terrible Brexit news when everybody thought it was going to be yes and it was no. Woof, the market flew down 2,000 points. 2,000 points. You can see everything that happens in the countries from this. But this is what you get taught to run. This is where you place your trades. You place a new order. Yeah, you put a certain amount of money on it. Yeah, this is the GBP USD. It's running a little slow at the moment. There we go. See how I showed you? Look, this is 86.3 and this is 86.4. When people join Bizzcareer, they get an institutional account. In other words, you pay a tiny amount for spread. You're going to get an account in Bizzcareer, which only the institutions get because you're covered under our institutional license. If you want to put a certain amount of money, and we'll talk about this tomorrow, what is that certain amount of money you put on? It's something called 0.1 here. Well, what is that? I'll teach you tomorrow. Now you know how far a market moves. You can now start to measure how far a market moves. And therefore, we have the first bit of our equation, which teaches us how much money we can make on a trade. So it's just a little look at it. So if we look and just summarize and finish for this module 2, what is a pip and what does it mean? Well, you now know that a pip is the smallest whole number in measure in Forex. And it's usually the 4th decimal place on a quote. And you know what a quote is now. Yeah, you know, you've seen it in exchanges. You know, when you go to America, you get a certain amount of money for your pound, but you know exactly how it's worked out now. Also, you can see what a quote is on a broker. Is it 4 or 5 decimal places? And also, you're now starting to learn how to calculate pips. You can measure pips and know what it means. You know that a pip is a certain movement of distance of a market, and you have the first part of the equation to work out how you make money in Forex. And we'll continue that tomorrow. As an example, if you had the Euro US, GBP US dollar at 1.2853 and you placed a trade on it, and you closed it at 1.2850 in a sell, you will have made 3 pips. If it was 40, for instance, 1.2840, you know that's 13 pips. 53 to 40 is 13 pips. You would have won 13 pips. And that is the end of training module 2. Okay, let me just